Hello, everyone. My name's Stephen White, and today I'm going to talk about how S-Corporation owners can avoid hundreds of thousands of dollars of future income taxes by using this one simple strategy. It's used by banks, Wall Street, billionaires, and even your peers have caught on to this. So if you're an S-Corp owner and you're age 40 to 55, earning in excess of $250,000 per year in income and distributions, keep listening. You're at the right place at the right time. Today, I'm going to give you this information at absolutely no cost to you. It's 100% free. So in this video, I'm going to show you how to avoid hundreds of thousands of dollars of future income taxes utilizing one simple strategy. Again, it's used by your peers, banks, Wall Street, and billionaires. I'm going to briefly discuss the three approaches to building wealth according to traditional, and I believe it's outdated, planning methods. I'm going to expose the three biggest and costly tax problems of traditional planning and how to avoid them. So let's dive in. Pay tax once for S-Corporation owners. Let's first look at this diagram here. It's a real simple piece. You're an S-Corp owner. Maybe you own a couple different S-Corporations. You have an opportunity to buy two more businesses, maybe three, but let's just look at two. Business A is producing $5 million in gross revenues. It's paying you $200,000 in taxable income. The other business, Business B, is producing $3 million in gross revenues. It's paying you $180,000 of tax-exempt income. So just based on this information, and I know there's a bunch of other factors, but just based on this information, which one would you buy? If you chose B, you are correct. Keep listening. My next question is, if you wanted to scale, would you also scale B? Absolutely. Creating multiple income streams of tax-exempt income would be the ultimate goal. It'd be the ultimate dream in most cases. Let's take this a step further. This circle represents all of your net worth. So everything that you own, your house, your investments, your cash accounts, all of your net worth. And let's pretend that this circle is actually a pie. And I'm going to take the knife and I'm going to make one slice. I'm going to then hand you the knife and ask you, if this is all of your net worth, at the end of the day, how much of it do you want to share with the IRS? The taxing authorities. I'm going to hand you the knife and ask you to make the next slice. Well, if you make the next slice over my slice, or very, very little, keep listening. The rest of this information is for you. So let's break down your net worth. Over my 20-year career in this business, I've learned that our net worth consists of lifestyle money. In other words, the money that we use to create a wonderful lifestyle. We also have our accumulated assets. So that's all of our accounts, all of our cash, everything, properties, business, everything. That's our accumulated assets. And the third category, the third piece, is what I call transfers. And my peers and I that I've studied with over the past 10 years, we've identified 32 different transfers. And what transfers are is money and your wealth leaving your ledger either unnecessarily or unknowingly. So just think about hundreds of thousands of dollars leaving your accounts unknowingly and unnecessarily. Now, I'm not going to get into all 32 of the transfers. I'm just going to talk about a couple. And then we're going to dive in to the three ways of what we're taught of how to create wealth and the tax problems and the tax problems that they present to us. Let's look at how money works. This is more about the flow of money and the cause and the effect of the flow of that money. I'm going to draw a line. We're going to call this the $0 line. So what we're going to talk about is how money flows for the saver and how money flows for the borrower. You've probably seen this before, but if you haven't, this is a really big eye-opener. So as savers, we save and we put our money away, and then we make a major purchase. And when we make a major purchase, we're removing that money from the account. And that account could be growing, it could be compounding, but we remove the money from that account. And if we're just doing this to buy our vehicles over a lifetime, we're doing it over and over and over again. Now, the borrower, on the other hand, takes out a loan, pays it back over time, does it again, pays it back over time. The key is, and the point I want to make is, whether you're the saver or the borrower, you're ending back up at the zero line. The saver is losing interest or losing money is what I say. And what I mean by that is when you pull money out of account, you're stopping all the forward momentum of the money in that account. It's no longer growing. It's no longer compounding. It's no longer earning. We call it a lost opportunity cost. And that opportunity cost is hundreds of thousands of dollars, and even in many cases, millions over a working lifetime. The borrower is paying interest to the bank or paying interest to an entity that gave them that loan. So here, if we're paying interest, we're obviously losing money, and we're paying more than we really have to for that asset. We've done some examples on this. The average couple with two cars, $350 a month payment. I know that's low. But when you look at this over a 20, 25 year period, it's a $1.5 million loss. Because again, we've taken that money out of the account. It's lost all its momentum, all its growth forever. Here we're paying interest. It gets really expensive paying interest. We can show you here in a little bit how to totally avoid that and lessen the swing for you. In my next example here, I want to show you the difference between compounding money and money that's in a growth vehicle, because they're two separate things. We're always taught, put money in the market, do this, invest in this because your money compounds. That is false. Money does not compound if we're investing in the equities markets. A compound curve is the money never loses any value. It continues to grow and grow and grow. And when you get to a certain point on that compound curve, it's like a hockey puck. You can't stop it, but you can stop it. And the way to stop it is when you remove that money from the account. Again, we go back up to this example on the saver. When we remove the money from the account, we actually flatten our compounding curve. So instead of ending up here, we're ending up down here. And if we do this over and over and over again, we're diminishing our return and we're stopping our compounding. And if you look at a compound chart over a 30-day period, you just miss 1, 2, or 3 of those days, and it's a significant difference in loss of money. The next piece is, let's just look at a line graph of what the stock market does. And I'm not against the stock market, but money doesn't grow in the stock. Money grows in the stock market, but it doesn't compound. That's a growth line. You can see that we're losing money here, we're losing money here, we're losing money here, gaining here. That's not compounding, folks. That's growth. And the strategy that we're going to discuss today is all about compounding and not interrupting your compounding. So let's dive into the 3 ways that we're taught on Main Street on how to create wealth. The first method we're going to talk about is what I call an always taxed asset. In other words, no matter what we do with that money, once we put it in this bucket and once it comes, the growth might be tax deferred, but when we go to use this money, it's going to be taxed, and it could be heavily taxed. So always tax bucket, we call this an income tax. And the income taxes in this country have changed 11 times since 1981 and 7 times since 1986. It's hard to plan when you have a moving target like that. What I call always tax are mostly your qualified accounts. You guys have all heard of 401ks. You've heard of SEPs. You've heard of IRAs. You've heard of cash balance plans. Okay. And the big deal on these is our advisors tell us, hey, if you put money in these accounts, you're going to lower your tax this year. Well, that's the problem. You're going to lower your tax this year, but you're actually postponing your taxes. And my question for you is, what's your belief on income taxes? The government's $34 trillion in debt. Are taxes going to stay the same, or are they going to increase? I don't know, but if I were to bet dollars to donuts, we're going to have a tax increase somewhere, and we have no say over that. So again, we're postponing taxes into the future. Now, can you tell me what tax rates are going to be 5 years, 10 years, 15, 20 years from now? Nobody can. We just don't know. We have absolutely no control of that. In these accounts, we provide 100% of the funding. We provide 100%, or not provide, but we take 100% of the risk, right? And we pay 100% of the fees on these accounts. And we're also paying fees on the money that we're using to pay our taxes when we go to use these dollars. So tell me how this can be a good deal. We have a business partner in this bucket that does not take any risk, does not pay any of the cost, does not provide any of the funding, and then at the end of the day, that can take up to a third, 30, 40% of our money when we go to spend it. Again, who knows what taxes are going to be? And the taxes I'm talking about are federal and state. Now, if you live in a state that doesn't have any state taxes, God bless you, that's awesome. But the federal taxes is what are the most concerns of all the people I talk to in my practice. The biggest concern and the biggest expense for retirees is income taxes. The biggest expense for working S corporation owners are income taxes. And we're taught to put monies into these plans to postpone not postpone, but we're taught to put money in these plans so we can save a little bit of money. Well, if you take that amount of money that you just saved in taxes and you bring it out 10, 15 years, the growth of that money, and let's just say it's the same tax rate, say it's 25%, you'll notice that that tax bill on that particular deferral is way more than what you saved last year on your tax return. Here's another kicker with this particular bucket. You guys have always thinking you're going to, at some point, take money out of this account. There's a safe withdrawal rate, which is 4%. If you were to Google safe withdrawal rate, Monte Carlo simulation, Trinity study, you're going to see numbers anywhere between 2.9 and 4%. 4% is the maximum that I would ever want to deal with, because again, when the money's come out of this bucket, they're going to trigger an income tax. Now, that trigger on your income tax is also going to could trigger Social Security tax. So up to 85% of your Social Security benefits are going to be taxed at your marginal rate. That's not a good deal. In addition to that Social Security tax, you're going to possibly get an IRMA adjustment on your Medicare health insurance premiums. The basic health insurance Medicare premium today is right around $135, $145. I've seen clients where they're paying as much as $489 a month, and that's just not combined. That's each husband and wife paying $489 a month for their Medicare premiums because they did a really good job, but they put all of their money inside their qualified account, and they have no way out of this. No way. Now, when you look at the taxes on the average household couple, when you look at the taxes on their Social Security benefits during their retirement lifetime, I've calculated as much as $250,000 extra in taxes paid on Social Security benefits over their retirement lifetime. Now, where are you going to get the money to pay for your Social Security taxes? Well, if you withdrew your 4% and you net it out after taxes at some amount, depending on what your tax bracket is, you're going to have to go back to the bucket to take more money out to pay your taxes on your Social Security. And then, wait a minute, you just got IRMA'd, so now your Medicare premiums are even more. So now you got to go back to the bucket to take out more money to pay the increase on your Medicare premiums. Now, if you're going to have to go back and take more, aren't you going to exceed the 4%? This is crazy. Absolutely crazy. This is not a good deal. And many of you know this. Many of you have suspected it for years. Again, we're not deferring income. We're postponing our taxes on that money we're deferring. And we don't know what the taxes are going to be. We don't know what our business partner is going to do to us when we get to the end of the line. In addition, we have zero access to these dollars. Zero. Of course, you could withdraw them but you have zero access, and unless you want to pay taxes. And then on top of that, you have a 10% penalty. And if you're the 35% tax bracket, that's 45% in taxes if you access this money before you reach age 59 and a half. So again, I'm not trying to depress you. I'm just trying to draw attention to what money looks like accumulated in this bucket and then spent down in this bucket. And I don't know if you've ever thought of this. Maybe you have, but if you have, you're in the right place at the right time to totally avoid this. You can certainly avoid this 100%. The next bucket we're going to look at is what I call sometimes taxed. And sometimes tax is any type of after-tax investment. We call this a capital gain. So it's a capital gains tax. And according to today's tax code, if your adjusted gross income is below $400,000, your capital gains tax is 15%. If your adjusted gross income is above $400,000 on your return, you're going to pay a 20% tax on any gains coming out of this bucket. Good news is this bucket was funded with after-tax money. So when you get or take withdrawals from this account, you're not going to get taxed on your basis. And your basis is what you put in it. Your basis has already been taxed. However, we still have the big problem, the very costly problem of income taxes on our Social Security and the triggering of getting IRMA'd, the IRMA adjustment on our Medicare health insurance premiums. Now, money's coming out of the sometimes taxed capital gains, only up to 50% of your Social Security is taxed. It's a little bit better deal, but you're still going to get taxed on up to 50% of your Social Security benefits. The second thing is you can get IRMA'd here. Again, if you go over certain thresholds, good old Uncle Sam's going to send you a letter saying, hey, your income was this. We're going to raise your Medicare B and C premiums to this. And who the heck knows what this will look like? And who the heck knows what capital gains taxes will be 5 years from now, 10 years from now, 20 years? We just don't know. But they're going to be there. They've been as high as 38%. The current administration, and you don't remember this because we've had so much crazy stuff going on over the last 3.5 years, but the current administration wants to tie capital gains to your highest marginal tax rate. So if you're in the highest marginal tax rate, it's over 40% when you add in the bend over tax here and the bend over tax there on Medicare and God knows what else. But these little bitty taxes that they tack on when you reach certain income levels, just, again, unnecessarily. To sum this one up, we have no idea what the federal capital gains tax is going to be. Like the first bucket I showed you, you're going to get a 1099. Who the heck knows how they're going to do that, but you're going to get a 1099 showing all the money, or at least that's not all. They're going to show the money that you took out, then they're going to show you the taxable amount. That's how that works in this particular bucket. Now I ask, how can this be a good deal? It's a little bit better than the previous bucket I showed you, but this is still not a good deal. Who knows what federal income taxes are going to be? Who knows what federal capital gains taxes are going to be? And who knows what the IRMA adjustments are going to be on our Medicare premiums? We just don't know. We can't predict that. We have no control over that. And again, in this bucket, you provide 100% of the funding. You take 100% of the risk. You pay 100% of the costs and fees, and your partner pays nothing. And your partner gets to decide whenever they want how much you're going to pay them. So now let's move on to the third bucket, and the best bucket of all. This third bucket is never taxed. This bucket is all about you putting your after-tax money into this bucket. Again, your pay tax once account. Once that money's in the pay tax once account, it's going to grow on a tax-deferred basis. And when you go to use it or spend it, those proceeds are tax exempt, not tax free. The only thing that's tax free in this bucket is a Roth account. Most of you make way too much money to be putting in a Roth, unless you have it in your 401k. Then again, who controls the Roth? Roth was created years ago by Senator Roth and a couple of his buddies. And the Roth was designed for lower, in my opinion, lower income folks that were just getting started. Because I've run numbers, people that put money in Roths that don't have it in their 401k. It really doesn't do anybody a benefit that earns over $75,000 a year. Again, that's just my analysis, my opinion. You can only put very little money inside of a Roth. I think the maximum is $6,000, $6,500 this year, maybe even more with catch-ups. But again, the government controls the Roth, and you still get a 1099 when you take money out of a Roth. My question is, if a Roth is tax-free, then why is the government issuing a 1099? I have my opinions. I'm not going to get into those right now. But anytime you get a 1099, Big Brother's watching. And the Roth rules can change. The Roth can change anytime the government wants to change the taxability of a Roth. Other instruments inside the never taxed bucket is what I call margin loans. So if you have a margin account, and what a margin account is, you have a really big pile of investments that you're willing to put up for collateral to go buy another stock. You pledge a certain amount of your investments. The brokerage firm gives you a loan off of their books to loan you money to go buy another security. The trick is, if that security loses value to a certain degree, you're going to get what's called a margin call, and you're going to have to pay back that loan. And you have to have that money to pay back that loan. Well, if your other investments that were used as collateral dropped as well, you're going to be in a tight spot. I don't know if you guys remember, many of you probably do, the movie Trading Places, where the two old guys got tricked at the end of the movie, where they tried to corner the orange juice market in Florida. Well, they made the wrong bet, and not only did they lose their entire fortune, they got kicked off of the exchange because they went broke big time. Now, that's a very severe occurrence of a margin account, but that's how margin loans work. The other components in here is what's called a reverse mortgage. I'm not advocating for a reverse mortgage. Talk to your mortgage broker or your CPA about that. But reverse mortgages, the proceeds coming out of a reverse mortgage are non-taxable. You don't get a 1099 when you take money out of a reverse mortgage. The other type of instrument inside of this never taxed is any kind of loan. Were you taxed on the loan that you took out to buy your home? No. Were you taxed on the loan that you took to purchase your vehicles? Absolutely not. So loans are tax exempt. Loans are tax exempt. Loans are tax exempt. You do not pay any tax on loans. It's a transfer of capital. The other instrument in this is what we call limited pay, whole life insurance contracts. Limited pay whole life insurance contracts have been around for decades. And it is by far the most predominant strategy used by banks, Wall Street, billionaires, and your peers to build tax-exempt cash flow. Not income, cash flow. Cash flow is a transfer of capital, much like a loan. When you use the funds inside of your limited pay contract, it's considered cash flow. It's not taxed. You don't get a 1099. And there's no place to put it on your return. Matter of fact, if your only cash flow or money in retirement came out of this contract, in addition to your Social Security benefits, you're not even required to file a tax return. The government already has what they sent you. Money coming out of a limited pay whole life contract is considered cash flow, a transfer of capital. They don't even know you have the darn thing. You actually own this. You own the contract. We don't own our 401ks or IRAs. We're beneficiaries. We own our brokerage accounts, but we don't even own our qualified accounts. We're beneficiaries. Nancy Pelosi was right. Sorry to bring that up, but she was right. The government does. It's their money all the way. In addition to this, you pay zero tax. There's no IRMA adjustment on your Medicare premiums, and there's no tax on your Social Security. No tax at all on your Social Security. So you get 100% of your Social Security benefit, and you're paying the least amount for your Medicare insurance. Now, when I look at these three buckets, and again, if you stay to the end, I'll shoot you a white paper with a little bit more details. But if we look at bucket number one, and we're using an average, let's just say 2 million of assets with a 4% withdrawal rate, and the average couple today is receiving $45,000 a year in Social Security benefits, right? The net after you take out taxes, and again, in this example, I'm using a 25% tax rate. The net on all this, you're looking at roughly $88,800 to you. If you look at bucket number two, if you're looking at bucket number two, again, we're taxed a little bit differently because it's capital gains. But the net, and we're using all the same tax rates. We're using a 15% capital gains. We're using a maximum 25% income tax. Again, who knows what the income taxes are going to be. But in bucket number two, we're using all the same here, 4% safe withdrawal rate. The net to the household is roughly $113,000. Okay, and this is net. This is after tax. In bucket number three, remember we talked about a safe withdrawal rate of 4%? The withdrawal rates or the usage rates of your limited pay whole life contract went from 6 to 7%. And what's cool about that bucket is since there's no taxes on your Social Security, you get all your Social Security benefits, 100%. They're not taxed. In that particular example, when you look at the money coming out using 2 million, safe withdrawal rate of say 6%, let's just use 7%. Your total net to you is roughly $185,000. Whoops. I'm getting excited, can you tell? It's $185,000 net to you. That's a big difference, folks. That's almost twice of what's in bucket number one. Way more than bucket number two. $185,000 all tax exempt. 100%. No worries here. No IRMA. You don't have the IRMA adjustment. You're not going to get a 1099. Again, the contract is between you and the company that issued your limited pay whole life contract. There's no reporting requirements on a whole life contract. Zero. So I'm going to stop here. I'm going to write a couple of notes for you. But again, I want to review this. So let's go back and review to what we just covered. And I've got another offer for you should you want to pursue getting your own pay your tax once account. So let's go to the summary real quick. All right, let's summarize this. I showed how S-Corporation owners can avoid hundreds of thousands of dollars in future income taxes by utilizing one simple strategy used by banks, Wall Street, billionaires, and your peers. I also discussed the three approaches of creating wealth using traditional planning models. I exposed the three biggest problems of traditional planning and how to avoid them. Those three problems being income tax on your distributions and your withdrawals, the problem of the income tax on your Social Security benefits, and the problem with increasing your Medicare premiums, all of which cause you and force you to use money from other sources or perhaps those particular buckets to pay those taxes, to pay for those increases. I also gave you a plan to pay tax once and avoid hundreds of thousands of dollars of future tax and tax increases. I gave this to you for free. And again, I did that because I know you want this. So my free offer is click on the link below and schedule a 30-minute strategy session with me. And again, I am not going to charge you for this. Again, this is valuable information that I feel you should know and have in your quiver and in your toolbox. So click on the link below, schedule a call with me. Again, it's totally free. Get on my calendar. Let's have a meaningful conversation about your situation. And let's see how much of your wealth we can put in the Pay Tax Once account and how much wealth it can create for you and your family, giving you access to this money along the way. You are not locked away from this money. So click below. We'll show you how to have liquidity, access control, and save hundreds of thousands of dollars in future income taxes. Appreciate your time. You guys have a wonderful day, and we'll talk to you soon.